Hey guys, welcome back to the channel. Today's video is called Don't Listen to Influencers Who Don't Understand How High Yield ETFs Work. I watched a video this morning where an influencer was talking about ETFs with no NAV erosion. While such a claim might sound appealing and probably got him a lot of clicks, it's crucial to understand a fundamental truth of investing. There's no such thing as an income-paying ETF with zero NAV depletion. In reality, any fund that distributes a yield, even something like the SPY, experiences some level of NAV reduction. For instance, when the SPY announces their quarterly dividend, that amount, the amount of the dividend, is reduced from the share price. And the following morning, you get up and it looks like the SPY has dropped by whatever the amount of the dividend is. Now, here's the deal. The SPY's recent dividend yield is around 1.1% annually. So that equates to about 30 basis points per quarter. But your SPY looks like it drops a third of a point 4 times a year. This depletion is so negligible because of the small size of the yield, it's not often noticeable, but it does deplete. However, what many influencers are really referring to when they talk about erosion are high yield ETFs that suffer from excessive depletion. This occurs when an asset consistently pays out a high distribution significantly larger than its total return. Consider this. Some high yield ETFs distribute income as frequently as weekly, sometimes amounting to a staggering 1% per week or over 50% annually. Contrast that with the SPY's modest 1.1% yearly dividend. It's remarkable to think the SPY pays in an entire year what some of these high yield ETFs distribute in one single week. The critical point remains, all distributions, regardless of the fund, are paid directly from the fund's net asset value. The money simply has to come from somewhere. If it didn't come from somewhere, then it would be free money. If you still believe in free money, you're basically like somebody in high school that still believes in Santa Claus. My aim here isn't to disparage Santa Claus or high yield ETFs or the influencers who discuss them without a full grasp of the mechanics. On the contrary, these funds can serve as valuable tools, particularly for retirement income strategies. However, it's absolutely essential for investors to understand the true nature of their returns and exactly what they're signing up for. Today, I'm going to take a crucial yet often misunderstood, I'm going to look at a crucial yet often misunderstood aspect of investing, especially when it comes to high yield ETFs and the true composition of total returns. This concept can make or break your results, and understanding it can help you identify good investments versus bad investments. Many investors, particularly those who are attracted to high monthly income, tend to focus solely on the distribution yield an ETF pays out. While a high yield can be appealing, it only tells you part of the story. To get the full picture of an investment's performance, you must consider the total return. Let's break it down with the fundamental equation that I came up with. Total return equals NAV return plus distribution yield. My formula, I express it often or abbreviated as T equals N plus D. This is your key to unlocking the truth behind an ETF's performance. Of course, we know NAV stands for net asset value. The NAV return represents the change of the underlying value of the fund's assets per share, independent of the distributions paid out. In simpler terms, it's the growth or decline of the actual capital within the fund. Now, here's something I find helpful. If you know the total return and you know the yield, you can easily solve for the NAV return. NAV return equals total return minus distribution yield. A simple rearrangement of the formula, N equals T minus D, allows you to identify whether a fund's underlying assets are genuinely appreciating, stagnating, or depleting. When an ETF distributes more in yield than it can genuinely support through its underlying asset performance, i.e. when total return is less than distribution yield, you're witnessing what's commonly referred to as depletion, erosion, or decay. For high yield ETFs, depletion is the most accurate term. Consider this. If an ETF consistently pays out a distribution yield that exceeds its total return, it's effectively returning a portion of your original capital back to you rather than generating true profits. Over time, this can significantly diminish your principal, even though you're receiving a consistent income payments. However, receiving some of your own capital back, this is known as return of capital or ROC, can have tax advantages. However, this is a subject for further discussion on a future video. Leaving the tax benefits aside for now, let's look at some specific examples. All right, so here's one case in point. Defiance ETFs, for instance. Defiance is a great company with a lot of good ETFs, but their ETFs, especially triple QI, is often held up as an example of erosion. As such, many investors avoid them. So let's think about a typical year for Defiance. They might yield 50%. However, when you look at their total return, it might be 10%. Okay, well, let's use our formula and see what's actually happening there under the surface. All right, so NAV return equals total return minus distribution yield. So we know the total return is 10%. Distribution yield is, and then we have to subtract the distribution yield, which is 50%. 10 minus 50 equals negative 40. This calculated a negative NAV return of approximately 40% year after year clearly indicates severe capital depreciation. There's a trade-off for this. It's important to acknowledge that there's a trade-off for everything in life and investing. In a significant market pullback or downturn, some of these extremely high-yielding ETFs, like triple QI, can offer a buffer or a cushion and can perform a lot better compared to other funds. This is because the strategies are designed to generate income regardless of market direction. In a rapidly falling market, that preservation of income stream can give you a benefit. Let's look at an example of this cushion, and we're going to compare triple QI from NEOS with triple QY from Defiance in the recent April pullback. Many influencers claim that triple QI from NEOS has no NAV erosion. I like triple QI. They do a great job. It's stated that ETF has no NAV erosion. It's like saying that your breath doesn't stink in the morning. All morning breath is stinky. You may not think yours is, but it is. It's a fact of life. Now let's compare triple QI versus triple QI in the latest April pullback. So I'm going to bring up a chart of it. And as you can see here, triple QI, the one supposedly with no NAV erosion, declined by 14.52% over just a month, while triple QI from Defiance, the one that's often considered bad, was only down 10.75% over that same time frame. That's a 3.77 percentage point difference in depletion over just a month. On a percentage basis, this is about 35% more depletion from the supposedly safer ETF. Triple QY, 10.75, triple QI, 14.52. They were both down. Triple QI just a heck of a lot less. Why is this? It's because the high distribution yield, which acts like a tax on NAV return in a bull market, but it becomes a significant cushion on the NAV in a down market. Just imagine if this had been a more sustained pullback. Now, triple QI is a great fund, but the relatively lower yield offers very little cushion in a down market compared to the higher yielding alternatives. Let's just look at how much cushion triple QI had against the benchmark, which is triple Q or the NASDAQ. In this April pullback over the same time frame, triple QI did perform better than the triple Qs by about 1.73%. But this is what I mean when I say very little cushion. There you can see the chart of it. I guess that's better than nothing, but now let's look at the bad fund with all the supposed erosion. Triple QI against the same benchmark over the same time frame. A triple QI had 5.4% less downside, or about 3 times more cushion. That's a pretty big difference. You can see it right here. Same time frame, triple QY was down 10.75%. The Qs were down 16.15%. So which one's better, triple QI or triple QI? Well, if you knew you were going to get a down market, triple QY would have protected your capital better due to the high yield. The high yield itself is neither good or bad, depends on the situation. In a bullish market, the high yield will do worse because it is a tax on the upside, the NAV upside. But in a bearish market, the opposite is true. So now let's look at JEP-I and JEP-Q. So JEP-I is JP Morgan Equity Premium Income ETF, and JEP-Q is the JP Morgan NASDAQ Equity Premium Income ETF. These funds are known for their healthy but much smaller distribution yields, and they typically operate with a different philosophy regarding payout ratios. Many investors perceive that JEP-I and JEP-Q don't suffer from erosion, and there's a good reason for that. While their distribution yields are attractive, they're historically in the 8 to 10% range. their total returns tend to be higher. For example, if JEPI and JEPQ achieve a total return of 12% over a given period, over a year, and they pay an 8% distribution yield over the same year, that's a pretty typical year for these guys. Let's do the math on it. NAV return equals total return minus distribution yield. All right. So the total return is 12% in this hypothetical example. Distribution yield is 8%. What does that give us on NAV return? 4% NAV return. That's great. In this scenario, you have a positive NAV return, meaning the fund's underlying capital is actually growing, even after accounting for the distributions. I want to highlight another critical point going back to Defiance. Let's look at QQY, the supposedly bad fund with all the erosion. Now, let's just say that Defiance were to adjust their distribution policies to be more like JP Morgan. Let's say that Defiance reduced their yield to 8% and just left the rest of it back in the fund. It too, meaning QQY, would likely also demonstrate a positive NAV return, just like the rest of them, just like JP Morgan or just like the Dios fund QQI. Now, here's the actual results for the past calendar year. Starting share price, about $40, ending share price, about $25. The difference is the dividends collected per share, which is $8.09. Total return was 10.31. So now let's look at this. Here's how the math would work if QQY cut its dividend to 8%. Look at the chart above. Notice the starting NAV of 39.63. So an 8% yield on that starting NAV would equal $3.17. Now let's look at the actual total annual dividends collected per share from QQI last year, which was $18.09. So instead, if QQY had only paid $3.17 instead of $18.09, that would have left an extra $14.92 to go back into the NAV. So let's add this $14.92 back into the NAV per share. So before the hypothetical dividend cut, the NAV per share the ending NAV per share was $25.63. Okay, so $25.63 plus $14.92 comes to $40.55. That's pretty good. And this calculation ignores the effect of compounding, so it likely might have even been slightly higher. But in this scenario, based on actual numbers from last August to this August, we've essentially fixed QQI's NAV problems. Its starting NAV balance was $39.63 for the year, and the NAV return would be up to $40.55 in our example. So that is a profit or a gain in NAV value of 92 cents per share. On a percentage basis, that equals 2.3%. Somebody call Sylvia Jablonski at Defiance and tell her we fixed her ETF. Hey, Sylvia. Oh, I'm sorry, Mr. Jablonski. Yes, ma'am. We fixed your ETF. All you have to do is lower the yield to 8%. All right, you're welcome. Oh, and don't forget, in this scenario, we also paid an 8% dividend. We can't forget about that, can we? So let's do our formula again. Total return equals NAV return plus distribution yield. Our calculated total return would be 2.3%, or the total return would equal 2.3%, which was the NAV return, plus the new NAV return with the lower dividend payment. 2.3% plus the dividend yield would be 8%. That equals 10.3%. Now let's check out what QQY's actual total return was the other way before we modified the dividend yield. The total return was 10.31. So 10.31 way, ignoring the effects of compounding, by the way, and 10.31 their way. This demonstrates a key point. It's essentially just moving money from one column to the other. It's like taking money out of one pocket and putting it into the other pocket. Remember, there's no such thing as free money, so this would make sense, right? Other things being equal, this is the way it has to work. Also, remember this crucial insight. In a strong bull market, where underlying assets are appreciating rapidly, the distribution yield can almost be thought of as a tax on the NAV return. While it provides income, it removes capital that could otherwise compound within the fund, leading to even greater long-term growth of your principal. Conversely, in a bear market, that same yield acts as a crucial cushion. Finally, understanding the relationship between total return, NAV return, and distribution yield is paramount for making informed investment decisions. Don't be swayed by high yields alone. Don't be swayed by influencers who have no idea what they're talking about. Always dig deeper into the numbers and make sure that this is a trade-off you're willing to accept. Happy Saturday from Hill Country. Time to take Jackson on a walk.